Silver crashes to 71 in the dark hours. Positions wiped out, fear everywhere. Then suddenly, a violent snapback. 71 to 83 before New York even opens. 17%. Overnight, gold follows. Bitcoin breaks first. Signals flash red across markets. Is this the moment weak hands are shaken out? Or is this just the calm before another flush? Another margin call. Another trap set in plain sight. Paper prices collapsing. While physical silver disappears, queues in Singapore, sold out dealers, premiums screaming something is wrong. So here's the real question. When New York opens in minutes, who breaks first? Paper or reality? Stay with me, because the next move decides everything. Welcome to Market Metal. If you're watching this and you've lived through a few crashes already, you know markets don't warn politely. If this kind of clear, no-nonsense analysis helps you think sharper, tap subscribe, slow and steady, just like good investing. And tell me in the comments, where are you watching from today? The event, what happened overnight, and why it matters. Silver did not fall quietly. It broke down hard, fast, and without warning during the overnight session. As global markets were thin and liquidity was low, the price of silver dropped sharply to around $71 per ounce. That move alone was enough to force liquidations across leveraged positions. But what followed was even more unusual. Before New York markets opened, silver reversed violently, rebounding from $71 to roughly $83. A move of that size, in that time frame, represented a gain of nearly 17% from the low. Gold followed a similar pattern, though with less speed. It suffered a steep intraday decline, losing hundreds of dollars per ounce before recovering a meaningful portion of the loss. From its lows, gold climbed back roughly 7%. These are not normal movements for assets widely considered monetary anchors. Gold and silver are not supposed to behave like high-risk technology stocks or speculative cryptocurrencies. Yet, overnight, they did exactly that. The first task in any serious analysis is to separate emotion from fact. The facts are straightforward. Silver collapsed, rebounded sharply, and did so before the most liquid trading session of the day even began. Gold followed the same pattern, though with less volatility. At the same time, other markets showed signs of stress. Equity futures were unstable. Bitcoin had already broken down over the weekend. Yields were moving. The dollar showed signs of strength. None of this was happening in isolation. What made this event stand out was not only the size of the move, but the speed and timing. These price swings occur during a period when participation is low and forced activity has an outsized effect. That is usually when margin calls occur, stops are triggered, and risk managers act without discretion. In such moments, markets do not move based on long-term value. They move based on survival. From a strategic perspective, this matters because violent rebounds often create confusion. Many market participants see a sharp bounce and assume the danger has passed. Others see the same bounce and assume it is a trap. Both interpretations can be wrong if the underlying structure is not understood. The purpose of this analysis is not to declare a bottom or predict the next price level. It is to explain what this behavior signals about the system itself. Historically, when gold and silver fall sharply, it is usually tied to one of two causes. Either fundamentals change or liquidity disappears. Fundamental changes are slow. They involve shifts in supply, demand, policy, or confidence in monetary systems. Liquidity events are fast. They are mechanical. They force selling regardless of belief. Overnight, nothing meaningful changed in the fundamental backdrop. Governments did not solve debt problems. Central banks did not reverse policy. Geopolitical risks did not vanish. Industrial demand for silver did not collapse. Yet prices moved as if something had broken. That disconnect is the first warning sign. In stable conditions, price discovery in precious metals reflects long-term expectations. In unstable conditions, price discovery reflects stress. When stress dominates, assets that are liquid and profitable become sources of cash. Gold and silver often sit at the top of that list. Funds do not sell what they want to sell. They sell what they can sell. This is a key distinction that separates strategic understanding from surface-level interpretation. The rebound from 71 to 83 in silver may look impressive, but context matters. A 17% bounce after a forced liquidation does not automatically signal strength. In many historical cases, sharp rebounds occur because selling pressure temporarily exhausts itself. Once forced sellers are cleared, prices lift. The critical question is whether new buyers step in with conviction or whether the bounce fades once normal trading resumes. This is why the New York Open matters so much. Overnight trading is dominated by derivatives, algorithms, and margin mechanics. The New York session introduces deeper liquidity, institutional flows, and broader participation. If the rebound holds under those conditions, it suggests that forced selling may be complete, at least temporarily. If it fails, it signals that deleveraging is still underway. Another unusual feature of this event is the scale of value destruction. In a matter of days, trillions of dollars were erased from the combined market value of gold and silver. Gold fell roughly 20% from its peak, wiping out several $1 trillion in notional value. Silver dropped nearly 40% at its worst point, erasing an amount comparable to the entire global cryptocurrency market. These are not small adjustments, they are systemic moves. What makes this even more concerning is that these losses occurred while traditional risk-off indicators behaved inconsistently. In classic crises, gold rises as equities fall. This time, both were under pressure. When traditional relationships break down, it often signals a liquidity-driven event rather than a valuation-based one. In such environments, correlations converge. Everything becomes a source of cash. From the perspective of business leaders and long-term capital allocators, this distinction is critical. Liquidity events create false signals. Prices can move far below intrinsic value and stay there longer than expected. At the same time, sharp rebounds can lure participants back in before stability returns. Understanding which phase the market is in can mean the difference between preservation and unnecessary risk. This event also raises a deeper structural question. If gold and silver can move like this without any change in fundamentals, well, what does that say about the pricing mechanism itself? It suggests that paper markets, leverage, and derivatives play a dominant role in short-term price discovery. Physical supply and demand do not disappear overnight, but their influence can be temporarily overridden. That does not mean fundamentals are irrelevant. It means they are delayed. In many historical crises, paper prices collapse first, while physical markets tighten quietly in the background. The resolution comes later, often violently, when confidence in paper claims erodes. Whether this event is moving in that direction cannot be known yet. What can be known is that the behavior fits the early stages of systemic stress. At this stage, certainty is not available. What is available is information. Silver touched 71 and rebounded sharply. Gold followed. Bitcoin had already broken down, signaling broader risk aversion. Liquidity appears strained. Forced selling is evident. The New York session has not yet confirmed whether the rebound is durable. This sets the stage for the central question of this analysis. Was the move to 71 in silver the clearing event, or merely the first break? Is the rebound a signal that stress has been absorbed, or pause before further deleveraging? These are not academic questions. They determine how risk should be managed in the days ahead. Part 1 ends here, not with answers, but with a framework. The event itself is clear. The meaning is not yet resolved. To understand what comes next, it is necessary to examine the leading indicators and transmission mechanisms that preceded this move. That is where the real warning signs emerge. The signal beneath the surface. How liquidity stress travels through markets. Before silver collapsed to 71, the signal had already appeared elsewhere. It did not come from mining data, industrial demand, or monetary policy statements. It came from a market most traditional analysts still treat as peripheral. Bitcoin moved first. The sequencing matters. In modern markets, Bitcoin often acts as the earliest pressure valve. It trades 24 hours a day. It is highly liquid. It is heavily leveraged. And most importantly, it is the first asset institutions reduce exposure to when risk tolerance suddenly shifts. When Bitcoin breaks sharply, it is rarely just about crypto. It is about liquidity. In the days leading into the precious metals crash, Bitcoin failed at critical levels. It did not simply drift lower, it broke decisively below zones that had previously acted as support. Weekend trading confirmed the weakness. Prices fell into the mid-70,000 range, briefly touching even lower levels. This was not noise. It was a signal that large participants were de-risking. The logic is simple, but often ignored. When capital is plentiful, leverage expands. When capital tightens, leverage collapses. The collapse does not happen evenly. It spreads outward from the most sensitive markets to the most stable ones. Crypto first, then equities, then commodities. Finally, precious metals. This sequence has repeated across multiple stress events. The mechanism is mechanical, not emotional. Funds that operate across asset classes manage risk at the portfolio level. When losses appear in one area, capital must be raised quickly. The capital is raised by selling what can be sold, not what should be sold. Bitcoin's breakdown was the early warning. It told a clear story. Liquidity was being withdrawn. Risk appetite was shrinking. Margin tolerance was tightening. Once that process begins, it does not stop at the first asset. It spreads. As Bitcoin fell, pressure began to appear in equity futures. Valuations that had already stretched to historic extremes suddenly looked fragile. At the same time, interest rate expectations shifted. Debt markets began to reprice risk. The system moved from optimism to caution in a matter of hours. This is the environment in which silver collapsed. Silver did not fall because its long-term outlook changed. It fell because it sits at the intersection of leverage and liquidity. Unlike gold, silver is more volatile. Unlike equities, it is often used as a hedge. That combination makes it vulnerable during forced deleveraging. When margin clerks call, silver becomes a source of cash. The selling pressure that drove silver to 71 did not come from a coordinated belief that silver was suddenly worth less. It came from margin thresholds being breached. As prices fell, stops were triggered. As stops were triggered, derivatives unwound. As derivatives unwound, exchange-traded products were forced to reduce exposure. This created a cascade. This is where many observers make a critical mistake. They see selling and assume conviction. In reality, forced selling has no conviction at all. It is blind. It does not care about value. It only cares about meeting obligations. The sharp rebound that followed is consistent with this dynamic. Once forced sellers are exhausted, prices can lift rapidly. But that lift does not mean stress is gone. It means one phase of the process has completed. The key question is whether the rebound was driven by new capital stepping in or simply by the absence of sellers. These two forces produce very different outcomes. New capital brings stability. Absence of sellers brings temporary relief. Bitcoin's behavior after the initial drop is crucial here. If Bitcoin stabilizes, it suggests that the worst of the liquidity shock may be passing. If it continues lower, it signals that risk reduction is still ongoing. In such a case, pressure eventually returns to every asset class, including precious metals. This is why using Bitcoin as a leading indicator is not speculation. It is risk analysis. Bitcoin reflects the most immediate response to changes in liquidity conditions. When it breaks, it warns that stress is propagating. Another layer of concern lies in the broader debt structure. Over the next 12 months, an unprecedented amount of government debt must be refinanced. This refinancing will occur at much higher interest rates than in prior cycles. That alone creates pressure on the system. It forces institutions to hold more liquidity and reduce exposure to volatile assets. When this structural pressure meets short-term market stress, the result is instability. Liquidity becomes scarce precisely when it is most needed. Assets that are normally defensive can become sources of funding. This helps explain why gold and silver behaved in ways that seemed illogical to casual observers. In a liquidity-driven environment, logic based on fundamentals temporarily fails. Correlations converge, diversification breaks down. Everything trades as risk. The danger in such moments is misinterpretation. Some participants see the rebound and conclude the crisis is over. Others see the drop and conclude the system is broken beyond repair. Both extremes miss the point. What matters is the process, not the emotion. The process underway is deleveraging. Deleveraging is not a single event. It unfolds in stages. The first stage is denial. The second is forced selling. The third is temporary stabilization. The fourth is either recovery or deeper stress, depending on whether liquidity returns. Markets are currently between the second and third stages. Silver's rebound from 71 to 83 is significant, but it has not yet been confirmed by broader market behavior. Bitcoin remains unstable. Equity valuations remain stretched. Debt pressures remain unresolved. Nothing fundamental has been fixed. This sets up a moment of maximum uncertainty. The appearance of relief collides with unresolved structural stress. That is where traps are formed. It is also where opportunities emerge for those who understand the difference. The next confirmation will not come from headlines. It will come from market behavior at the open. If selling pressure resumes across risk assets, the rebound in silver will be exposed as temporary. If stability spreads, it suggests forced liquidation may have run its course, at least for now. At this stage, no responsible analyst should declare victory or defeat. What can be said with confidence is this. The move in silver did not originate in the silver market itself. It originated in liquidity stress that began elsewhere and worked its way inward. Understanding that transmission is essential. Without it, every bounce looks like a bottom and every drop looks like disaster. With it, the chaos begins to form a pattern. Part 2 ends with a warning, not a conclusion. The system is under strain. Signals are flashing. The rebound may be real or it may be temporary. To distinguish between the two, one must look beyond price and into structure. That structure becomes unmistakable when paper markets are compared to physical reality. That is where the next layer of the story emerges. The fracture. Where paper prices break away from physical reality. While silver prices were collapsing on screens, something very different was happening away from them. The divergence did not appear in charts or headlines. It appeared in availability, premiums, and behavior. This is where the story stops being about volatility and starts being about structure. Paper markets moved first and fastest. Futures prices dropped violently. Exchange-traded products unwound exposure. Options cascaded through stop levels. Liquidity vanished precisely where leverage was highest. On paper, silver looked broken. In the physical market, it did not. This contrast is not anecdotal. It is systemic. In periods of stress, paper markets react immediately because they are designed to. They are instruments of speed. Physical markets react slowly because they are constrained by logistics, inventory, and real-world demand. When the two move in opposite directions, it signals that price discovery is no longer unified. One of the clearest indicators of this fracture is the premium between regions. As Western paper prices fell toward the low 80s, prices in Asia told a different story. Shanghai spot prices remained far higher. Futures in China reflected persistent tightness. The premium between Eastern physical markets and Western paper markets widened into the double digits, even after compressing from extreme levels earlier in the weekend. A premium above 20% is not a rounding error. It is a message. It says that the price clearing paper trades does not clear physical supply. It says that buyers who want delivery are paying far more than traders who want exposure. Backwardation reinforces this message. In normal conditions, futures prices are higher than spot prices. They reflect storage, financing, and time. When spot prices exceed futures prices, the market is saying something uncomfortable. It is saying that metal now is worth more than metal later. That condition rarely appears unless supply is tight or confidence in future delivery is uncertain. Silver remained in backwardation through the crash. This detail matters because backwardation should not persist during a genuine collapse in demand. If silver were truly unwanted, spot prices would fall relative to futures. They did not. The structure remained inverted. The implication is straightforward. Physical demand did not disappear. It intensified. Behavior at the retail and wholesale level confirms this. In multiple regions, dealers pulled offers. Inventories thinned. Availability tightened. In some markets, buyers queued even as prices fell. This is not the behavior of a market rejecting an asset. It is the behavior of a market exploiting a dislocation. This is where many observers become uncomfortable. The idea that prices can fall sharply while demand rises seems contradictory. It is not. It is the natural outcome of a system where paper claims far exceed physical supply. In Western precious metals markets, paper silver outnumbers real silver by a wide margin. Futures contracts, options, and synthetic products create layers of claims that settle in cash, not metal. This system functions smoothly when confidence is high and leverage is manageable. It becomes unstable when stress forces participants to demand liquidity all at once. During such moments, paper prices can be driven down aggressively without changing physical reality. The mechanism is simple. Selling pressure in derivatives overwhelms price discovery. Meanwhile, physical buyers quietly step in, constrained not by price but by availability. This is why attempts to interpret silver's crash purely through charts fail. Charts reflect paper behavior. They do not reflect queues, vault withdrawals, or regional shortages. Those signals exist elsewhere. The Reserve in Singapore, one of the largest private silver vault operators in the world, reported increased physical demand during the crash. That statement alone contradicts the narrative of collapsing interest. It suggests that while traders were exiting positions, long-term holders were increasing them. Even more striking is the pricing on China's largest e-commerce platform. There, silver traded at prices approaching double Western spot levels. A premium near 95% is not a market inefficiency. It is a breakdown in arbitrage. It means metal cannot move fast enough or in sufficient quantity to equalize prices. When arbitrage fails, markets fragment. When markets fragment, paper prices lose authority. This does not mean paper markets are irrelevant. It means they are vulnerable. They depend on confidence that claims can be settled. When that confidence weakens, price becomes unstable. The response from exchanges adds another layer of tension. Daily limit down moves in Chinese silver futures locked trading to one side. Liquidity evaporated. Two-way trading disappeared. That is not a sign of calm. It is a sign of stress containment. Yet, even under that stress, physical vaults remained stable. Inventory did not collapse. The premium held. The message remained consistent. Paper was breaking. Physical was not. This is the core fracture now facing precious metals markets. Two parallel systems are attempting to price the same asset. One is fast, leveraged, and liquid. The other is slow, constrained, and real. During stable periods, they align. During crises, they diverge. History shows how this resolves. Either physical demand weakens and paper prices are validated, or paper claims are repriced upward to reflect scarcity. The latter outcome tends to occur when leverage unwinds faster than supply can respond. Silver is particularly exposed in this process. It is consumed industrially. It is not hoarded to the same extent as gold. Above-ground inventories are limited. Mining supply responds slowly. These characteristics make silver a pressure point. This does not guarantee an immediate repricing. In fact, it often guarantees volatility first. Paper markets can overshoot in both directions. They can fall too far and rebound too fast. Physical markets adjust later. This is why the current moment is dangerous for those relying solely on price. A falling paper price can create false confidence that risk is gone. A rising paper price can create false confidence that stability has returned. Neither tells the full story. The real signal lies in whether the divergence narrows or widens. If premiums compress toward zero, physical demand is weakening. If premiums expand, paper is losing control. At present, premiums remain elevated. Backwardation persists. Availability is constrained. These are not the conditions of a market in fundamental collapse. They are the conditions of a market under strain. And the unresolved question is not whether silver is scarce. The data suggests it is. The unresolved question is how long paper markets can continue to dictate price in the face of that scarcity. That question will not be answered overnight. It will be answered through behavior, through delivery stress, through inventory changes, through the response of exchanges and participants. Part 3 ends with this tension fully exposed. Paper prices have spoken loudly. Physical markets have responded quietly. They are telling different stories. Which story prevails will determine whether the rebound from 71 was the end of the shock, or merely the midpoint. That resolution depends on what happens next, when the most liquid market in the world opens and decides whether to confirm the fracture or deny it. That decision comes with consequences. The decision window, confirmation, failure, and what comes next. By the time New York opens, the easy explanations are gone. Overnight moves can be dismissed as thin liquidity. Weekend volatility can be blamed on algorithms. But when the deepest pools of capital enter the market, price behavior becomes a verdict. It confirms or rejects what came before. This is the decision window. Silver's rebound from 71 to 83 created a fork in the road. On one path, forced liquidation is largely completed. On the other, the rebound is merely a pause before another wave of selling. Both outcomes are plausible. Only behavior can decide which one is real. The bearish scenario begins with a simple condition. The rebound fails. If selling pressure resumes at the open, it suggests that liquidity stress is still propagating. In that case, silver would be vulnerable to a retest of 71 or lower. The logic is mechanical. Margin requirements have increased. Risk managers are cautious. If traders cannot post additional capital, positions are reduced regardless of belief. Forced selling resumes, not because value has changed, but because capacity has. This scenario is reinforced if Bitcoin fails to stabilize. Bitcoin remains the fastest feedback loop for risk tolerance. If it breaks lower from already depressed levels, it signals that deleveraging is not finished. That signal does not remain contained. It spreads to equities, commodities, and eventually precious metals. In such conditions, correlations tighten again. Everything trades as risk. Equities are particularly exposed here. Valuations remain historically stretched. When highly valued markets encounter tightening liquidity, the adjustment can be abrupt. If equities gap down and volatility spikes, precious metals are often pulled with them in the initial phase. This is counterintuitive, but consistent with past deflationary shocks. In 2008 and in early 2020, metals fell alongside stocks before later diverging. In the bearish path, silver's volatility is not a warning of opportunity. It is a symptom of instability. The rebound becomes a relief rally that exhausts itself once deeper liquidity tests begin. Confidence erodes. Participants step back. The market searches for a lower clearing price to complete deleveraging. The bullish scenario requires a different set of confirmations. The rebound must hold under pressure, not for minutes, but for hours. Selling must be absorbed rather than accelerated. Volume must stabilize. Bitcoin must stop making lower lows. Equities must at least pause their decline. These are not signs of strength, they are signs of exhaustion. If these conditions appear, the interpretation changes. The move to 71 becomes a clearing event. Forced sellers are removed. Weak hands exit. Price stabilizes not because optimism returns, but because pressure subsides. In that environment, even modest buying can have an outsized effect. Silver is particularly sensitive to this transition. Its market is smaller, its inventories are tighter, its volatility is higher. When selling pressure disappears, price can reprice quickly, not because fundamentals suddenly improved, but because they were never reflected accurately during the liquidation phase. This is where physical markets regain influence. Elevated premiums, persistent backwardation, and constrained availability begin to matter. Paper prices can fall faster than physical reality adjusts, but they cannot remain detached indefinitely. When liquidity stress fades, the reconciliation process begins. That reconciliation does not require panic buying. It requires normality. It requires time. If paper claims continue to trade while physical demand remains firm, the imbalance grows. Eventually, one side must move. Historically, it is paper that adjusts. For decision makers, the critical mistake at this stage is overconfidence. Declaring a bottom prematurely invites risk. Declaring collapse invites paralysis. Both positions ignore uncertainty. The correct posture is conditional readiness. This means monitoring confirmation signals rather than price alone. Does the rebound hold through the New York session? Does Bitcoin stabilize within a defined range? Do equity markets absorb selling without cascading? Does the premium between physical and paper markets compress or expand? Does backwardation persist? Each of these answers adds information. None provides certainty on its own. There is also a broader macro backdrop that cannot be ignored. An unprecedented volume of government debt must be refinanced in the coming year. Interest costs are rising. Fiscal discipline remains unresolved. These forces do not create daily volatility, but they shape the environment in which volatility occurs. They make liquidity shocks more likely and more severe. This is why the current event cannot be dismissed as noise. It fits into a pattern of increasing systemic fragility. Markets that once moved independently now react together. Assets once considered stable now behave like speculative instruments. These are not signs of health. At the same time, history offers perspective. Extreme moves often occur near turning points, not because the future is clear, but because positioning becomes extreme. When sentiment collapses and volatility spikes, markets approach inflection zones. Whether they resolve upward or downward depends on liquidity, not narrative. Silver S decline of nearly 40% and rebound of 17% places it firmly in that zone. It is neither safe nor broken. It is exposed. For those managing risk, the message is simple but uncomfortable. Leverage is dangerous in this environment. Speed is deceptive. Patience matters. The next confirmation will not come from headlines or commentary. It will come from whether markets can function without forcing participants out. And the unresolved tension remains intact. Paper markets are showing stress. Physical markets are showing tightness. These signals cannot coexist indefinitely without consequence. Either physical demand weakens, validating lower prices, or paper prices are forced to reflect scarcity. The timing of that resolution is unknown. The direction will not be decided by opinion. It will be decided by behavior. As New York opens, the market is asked a direct question. Was 71 the clearing price or merely the first break? Is the rebound a foundation or a trap? There is no shortcut to the answer. It will emerge in real time through confirmation or failure. For those watching closely, this is not a moment for excitement. It is a moment for discipline. The opportunity lies not in predicting the outcome, but in recognizing it when it appears. The decision window is open.